All right, let's jump right into this explainer about what is honestly one of the most spectacular financial collapses in Wall Street history. We're talking about a story where unparalleled academic genius met absolutely unimaginable financial ruin. We're going to unpack exactly how a team of literally the smartest people in the room built a money-making machine that seemed infallible, only to accidentally bring the entire global financial system to the brink of collapse.
Just take a second to really absorb this number. $1.25 trillion. That's trillion with a T. This represents the total value of the derivative positions controlled by just a single hedge fund, long-term capital management. And here's the crazy part. They controlled this astronomical exposure with a core capital base of only about $3 billion. So how on earth did they achieve this mind-boggling level of leverage? And why did the market just let them do it? Let's find out.
Section 1. Rise of the Geniuses. We're starting our journey back in 1994, exploring how a team of financial wizards rapidly conquered the markets. Founded by John Meriwether, who was a pioneer of fixed-income arbitrage at Salomon Brothers, LTCM started out with $1 billion of capital. Fast forward just 3.5 years, and their net capital had absolutely ballooned to $6.7 billion. Now, they weren't just a traditional hedge fund. Operating out of Greenwich, London, and Tokyo, they acted way more like a massive capital market intermediary, essentially wholesaling risk from major investment banks. And get this, they weren't just making money, they were consistently achieving staggering, market-beating returns. Just look at these figures, nearly 43% in 1995 and almost 41% in 1996. They pulled this off with a true dream team stacked with PhDs and literal Nobel laureates like Robert Merton and Myron Scholes. Because of this elite pedigree and flawless track record, they charged top-tier fees, a 2% base and a massive 25% incentive fee, which was way above the industry standard. But for years, investors happily paid up because, hey, the models just kept working.
Section 2. The Art of Arbitrage.
To really understand how they got those breathtaking returns, we have to break down their secret weapon, convergence and relative value strategies. Okay, so picture two bonds that are nearly identical. On one side, we have newly issued treasury bonds, known as on-the-run bonds. Because everyone wants the newest, most liquid asset, their prices are slightly higher and their yields are lower. On the other side, we have slightly older, off-the-run bonds. Fundamentally, they're just as safe, but since they're a bit less liquid, they're slightly cheaper. LTCM's genius move was betting that over time, the price gap, or the spread, between these practically identical instruments would eventually close or converge. They'd buy the cheaper off-the-run bond, short the expensive on-the-run bond, and basically just wait for the prices to meet to make their money.
But here's the catch. The actual profit on these convergence trades was microscopic. We're talking sometimes just a few basis points, literally pennies on the dollar. So to hit those legendary 40% annual returns, they had to borrow massive amounts of money. They used what are called repurchase agreements, or repos, to basically borrow up to 100% of the cost of the bond, pledging the bond itself as collateral. They applied extreme leverage to amplify these tiny little spreads into massive profits. As the saying goes, they were picking up nickels in front of a steamroller, but they were picking up billions of them at a time.
Section 3. The blind spot in VAR.
Now, managing a trillion-dollar derivative portfolio, that takes some serious math. LTCM relied heavily on a metric called value at risk, or VAR. Basically, VAR looks at historical market data to predict the absolute maximum amount a firm could lose over a specific time frame with a given probability. Relying on their intensely complex VAR models, LTCM confidently assured themselves and their investors that their maximum daily loss would simply never exceed $50 million.
They were so incredibly confident in this math that they calculated a catastrophic 45% drop in their equity over a single month was a 10 standard deviation event, which meant they believed the probability of this happening was 10 to the power of negative 160. That is a number so infinitesimally small that they effectively concluded it was impossible in the history of the universe. Honestly, this just demonstrates a profound hubris. They assumed the past was a perfect, flawless indicator of the future, and they entirely ruled out the possibility of severe, unprecedented market shocks.
Section 4. The 1998 Market Collapse.
Because, as any seasoned investor knows, the past does not perfectly predict the future. And that impossible universe-ending event, well, it was just around the corner, ready to fracture the global financial system. It's actually stunning how fast it all unraveled. In early August 1998, global liquidity started drying up. Then came a totally unexpected, nonlinear shock,
Russia defaulted on its sovereign debt. This was unthinkable in LTCM's historical models. Suddenly, global liquidity just vanished in a panicked flight to safety. Instead of spreads converging, which, remember, is what their entire portfolio was betting on, spreads widened dramatically. By late August, that VAR model predicting a $50 million maximum loss was completely shattered. They were bleeding $100 million a day. By the fourth day after the Russian default, they lost a staggering $500 million in a single trading session.
So where were these devastating losses actually coming from? If you look at the breakdown, swaps at 35% and equity volatility at 29% really dominated the fallout. See, LTCM assumed their portfolio was highly diversified across global markets. But as the source material points out, they were fundamentally just replicating the exact same credit spread trade all around the world. So when the foundational premise of their model failed during a global panic, all of those seemingly independent trades suddenly became highly correlated. They lost heavily across almost all their massive positions at the exact same time.
And the pain certainly wasn't kept in-house. While LTCM partners absorbed 49% of the losses, major global banks took massive hits right alongside them. UBS alone absorbed 31%. Why? Because these counterparties completely failed to properly assess the systemic risk of LTCM's extreme leverage. The banks were so mesmerized by the Nobel laureates and the steady returns that they provided unprecedented financing without bothering to conduct their own adequate stress tests.
Which brings us to the climax of the whole crisis. The Federal Reserve Bank of New York ultimately had to step in and coordinate a $3.6 billion bailout funded by a consortium of major banks. Now, impartially speaking, the Fed intervened strictly to prevent a chaotic, uncontrolled liquidation. Academic sources note that if LTCM was forced to suddenly dump $1.25 trillion in derivatives into an already illiquid market, it could have severely paralyzed and disrupted the broader global financial system. Section 5. Lessons for today's investors.
So, a broader crisis was averted, but LTCM itself was dead. How do we apply this incredible cautionary tale to the increasingly complex and algorithm-driven markets we invest in today? Well, what actually separates failure from enduring success? Let's contrast LTCM with Jim Simon's Renaissance Technologies, another legendary, highly secretive quant firm that was active at the exact same time. Where LTCM abandoned their core formulas under pressure to take massive, highly correlated bets in illiquid markets, Renaissance maintained strict, unemotional discipline. They placed frequent, small, genuinely uncorrelated bets, and they stuck to highly liquid instruments. The lesson here from the sources is crystal clear. Genius fails when it overreaches, when it stops respecting the market, and when it assumes liquidity will always be there for them.
The big takeaway here is pretty simple, honestly. If you're managing a portfolio today, you can never rely solely on a single metric like VAR. Investors have to actively implement robust stress testing for absolute worst-case scenarios, even the ones that seem historically impossible. You have to account for funding and asset illiquidity because in a full-blown panic, you might not be able to sell your positions at any price. And as our sources remind us, the riskiest trades are very rarely the most profitable ones in the long run. Safety and survival just have to come first.
I'm going to leave you with this final, provocative thought to reflect on as you evaluate your own financial strategies. When we look at the wildly complex derivatives and automated trading of our modern financial system, are we truly rigorously testing for the impossible, or are we, right now, quietly trusting the math a little too much and repeating the exact same fatal hubris of 1998? Always question the absolute certainty of the models you rely on. Thanks for joining me for this explainer, and keep questioning the data.